Welcome to the deep dive. If you're involved in financial services, or maybe you just care about how your long-term savings and pensions are protected, well, today we are pulling apart the fundamental architecture of financial trust here in the UK. Our mission today is really to understand the logic behind the UK's Twin Peaks regulatory model. Why this structure? Why do we need it? It's because financial services, fundamentally, deals directly with people's economic futures, their security.
That's right. And without a transparent, resilient framework, confidence just evaporates.
Exactly, and we saw that, didn't we, back in 2008. When confidence goes, the entire system can just grind to a halt.
It absolutely can, and that framework is vital. Every decision made by UK regulators, really, it's guided by three core objectives. We aim for protecting consumers, maintaining market integrity, and promoting effective competition.
Three big goals.
Yeah, and importantly, we have to remember that those three things often exist in tension. They can pull against each other.
How so?
Well, take protecting consumers, for instance. Sometimes that means adding rules, right? But those rules might make it harder or more expensive for new competitors to come in and innovate. So there's a balance to strike.
Okay, that makes sense. So let's unpack this whole thing and maybe start with the history. Because this Twin Peaks model wasn't just dreamt up, it came out of a pretty serious failure.
It certainly did. If you look back before, say, the year 2000, the UK financial landscape was, well, it was a bit of a patchwork. Highly fragmented.
Different rules for different markets.
Exactly. Often relying on self-regulatory bodies for specific sectors, it was complicated, maybe inefficient.
Which is why, under the Financial Services and Markets Act, FSMA 2000, the government tried to centralize everything, put it all under one massive roof, the Financial Services Authority, the FSA.
That was the idea. One regulator to rule them all, essentially.
Yeah.
Simplify things.
But here's where it gets really interesting and maybe a bit painful. The FSA, this single peak, was responsible for everything from checking small print on insurance to making sure the biggest banks wouldn't collapse. Then 2008 hit, and the FSA was heavily criticized. What was the central flaw? What did 2008 expose about that single regulator model?
Well, the big problem was what you might call scope creep, or maybe just trying to do too much. It was tasked with being the conduct police for, the smallest advisory firm, and the guardian against huge systemic meltdowns.
Two very different jobs.
Very different mindsets needed. And arguably, it failed to prevent those big systemic risks because it got bogged down in the details, the micro-level stuff.
So focused on the trees, missed the forest fire.
That's a good way to put it. They became very good at looking at rule books, the sort of box-ticking approach. Are firms complying with rule XYZ? But they were so focused on that, they kind of missed the bigger picture risks, building up things like too much leverage across the system, inadequate capital buffers in major banks, the whole housing market bubble, stuff that threatened the entire economy.
And that realization that you can't really manage day-to-day ethical behavior and huge systemic stability threats with the same focus, the same tools. That's what led directly to the Financial Services Act of 2012.
Precisely. That act dismantled the FSA. It said, okay, this single peak didn't work for the big risks, and it built the Twin Peaks model we have now, deliberately separating conduct regulation from stability regulation.
Okay, so let's look at peak one then, the Financial Conduct Authority, the FCA. If you, listening, are a consumer buying insurance or getting a mortgage or investing, this is probably the regulator you're most likely to interact with, even indirectly.
That's right. Its central role is market conduct. How do firms behave? Are they treating customers fairly?
And this scale is just staggering. You mentioned earlier, how many firms does the FCA oversee?
It regulates over 50,000 financial firms. 50,000. Wow.
Yeah, it's huge, ranging from, the massive global investment banks right down to the smallest independent financial advisors on the high street.
So how on earth does it manage that? It can't possibly check every single transaction or piece of advice from 50,000 firms.
No, absolutely not.
No.
So its approach has to be very targeted. It's risk-based. They focus their resources where they think the greatest potential harm to consumers or markets might lie.
Okay, so what are its core operational goals? We know conduct, but what does that mean in practice for you, the listener?
Well, it comes back to those three pillars, but made more actionable. First, protect consumers. That means firms must put the customer at the heart of their business. And that's been really ramped up recently with the new consumer duty rules.
Right, a big shift there.
A very big shift. Second, protect the integrity of the UK financial system. That means keeping markets clean, transparent, fighting market abuse, insider trading, fraud, that sort of thing.
And the third one, you mentioned competition earlier. Yes, and this is important. It's not just about stopping bad things. The FCA has a positive duty to promote effective competition in the interests of consumers. They actively look at whether markets are working well, encourage innovation, and try to make sure dominant players aren't blocking new, maybe better services from reaching people.
Okay, so that focus on outcomes, on innovation, that links to this idea of principles-based regulation, doesn't it? It's often talked about as a key feature of the UK system compared to, say, the US. What does that actually mean for a firm?
It's fundamentally different from having a gigantic, highly prescriptive rulebook that tries to cover every single possible scenario. The U.S. system tends more towards that very detailed, rules-based approach.
Okay.
Instead, the FCA sets out 11 high-level principles for businesses. They're broad statements of intent. Things like firms must conduct their business with integrity, or pay due regard to the interests of its customers and treat them fairly.
So less about thou shalt not do X in situation Y under condition Z.
Exactly. The point isn't just to give firms a checklist. It's to force them, or perhaps encourage them, to think ethically and apply those principles even when facing a new situation that isn't explicitly covered by a detailed rule.
So it's about the spirit, not just the letter of the law.
That's a very good way to put it. If a firm follows a specific rule to the letter, but the outcome for the customer is clearly poor or unfair, the FCA can still step in and say, well, you might have ticked that box, but you breached Principle 6. Treat customers fairly. It elevates the standard beyond just technical compliance towards genuine ethical conduct.
And if firms don't meet those principles or break the specific rules,
Yeah.
the FCA isn't just sending polite letters, right? It has real enforcement power.
Oh, absolutely. Serious teeth, as you say. As I mentioned, they use a risk-based approach, so they target their investigations, but when they find misconduct, their powers are pretty comprehensive. They can levy huge fines. Millions, sometimes hundreds of millions of pounds. They can ban individuals from working in the financial services sector ever again. They can withdraw a firm's authorization, effectively shutting it down. And crucially, they can require firms to pay compensation directly to customers who've lost out due to their actions.
So it's designed to really change behavior, not just be a cost of doing business.
That's the intention. Deterrence and remediation.
Okay, so that's the FCA focused on behavior, conduct, fairness, competition. But that only works if the firms themselves are financially sound to begin with, which brings us to the other peak.
Exactly. Peak 2. The Prudential Regulation Authority, or PRA. This is all about financial stability.
Prudential supervision. And the key thing here is where the PRA sits organizationally, isn't it?
I mean, it's very important. The PRA is part of the Bank of England.
Right, the central bank.
Which gives it direct access to the bank's deep expertise on economic stability, financial markets, and crucially, its role as the ultimate backstop in a crisis. The PRA's focus is narrower than the FCA's, but deeper in a way. It supervises the big, systemically important institutions. Banks, building societies, major insurance companies.
The ones whose failure could cause widespread damage.
Precisely, the ones that pose systemic risk. So the PRA has two core objectives. First, promote the safety and soundness of these crucial firms. Make sure they can withstand financial shocks without collapsing.
And the second.
Specifically for insurers, it's to secure appropriate protection for policyholders. If a big insurance company fails, people relying on those policies, maybe for their pensions or their homes, need to be protected as much as possible.
Okay, so given that the PRA was born directly out of the failures of 2008, the failure to spot that systemic risk building up, how does it actually ensure this safety and soundness? What tools does it use?
It's fundamentally about prevention, about building resilience before a crisis hits. The main tools are capital and liquidity requirements.
Okay, break those down. Capital.
Capital adequacy means firms must hold enough of their own financial resources, capital buffers, to absorb significant unexpected losses without becoming insolvent. The PRA sets quite stringent rules on how much capital and what quality of capital banks and insurers must hold relative to the risks they're taking.
And liquidity.
Liquidity is about having enough cash or assets that can be very quickly turned into cash to meet your short-term obligations, even if funding markets dry up like they did in 2008. Think of a bank-run liquidity rules are designed to make sure banks can handle large outflows without collapsing immediately. The PRA monitors this very closely.
So it's about having shock absorbers, essentially, both for losses and for sudden cash demands.
That's a great analogy. Shock absorbers for the financial system.
Mhm.
And this all comes back to minimizing that nightmare term you mentioned, systemic risk.
Yeah, maybe just remind us, what did that look like in practice, and why is the PRA laser focused on preventing it?
Think of it like financial contagion or dominoes falling. Systemic risk is the danger that the failure of one really big interconnected institution, maybe a major global bank that does business with hundreds of other firms, doesn't just hurt that one firm.
It spreads.
It spreads rapidly through the entire system. If Bank A fails, then firm B, C, and D, who are owed money by Bank A, might get into trouble. Then maybe markets panic, credit freezes up, lending stops, and suddenly you have a potential collapse of the whole economy. Lehman Brothers in 2008 is the classic, terrifying example.
Right.
So the PRA's job fundamentally is to make those core institutions so financially robust, so well capitalized and liquid, that the failure of one, while still possible, is much less likely to trigger that kind of catastrophic system-wide meltdown.
Okay, so we've got these two powerful peaks. The FCA demanding ethical conduct, fair treatment, pushing for competition. The PRA demanding huge capital buffers, stability, risk aversion almost. How do they actually work together? It sounds like they could be in constant conflict.
Well, there is an inherent tension there, absolutely. Pushing for innovation and competition, which the FCA does, inherently involves some risk-taking. Demanding stability and big buffers, like the PRA does, can sometimes stifle that risk-taking.
So how is it managed?
The key is statutory cooperation and coordination. They are legally required to work closely together. They have regular meetings. They share intelligence. For example, if the FCA spots really poor conduct or governance at a firm, that's often a sign of weak risk management systems, which is something the PRA needs to know about immediately.
So bad behavior can be a red flag for financial weakness.
It certainly can be. And conversely, if the PRA sees a firm taking excessive risks to try and boost profits, that might lead to pressure to cut corners on customer treatment, which the FCA needs to watch. They have to communicate.
And who sets the overall direction? If there's a fundamental conflict between, say, promoting competition and ensuring stability.
Ultimately, the overall policy framework and the balance between these objectives is set by the government, by HM Treasury. They essentially define the playing field and the overarching priorities for the regulators. The implicit message is generally that stability, the PRA's remit for the big firms, is the absolute foundation. You can't have healthy competition or consumer protection if the whole system is collapsing.
Okay. And it's important to remember, isn't it, that the FCA and PRA aren't operating in a vacuum. There's a wider ecosystem of bodies involved in financial safety.
That's right. There's a whole support system. We mentioned HM Treasury setting policy. Then you have the Financial Ombudsman Service, the FOS. If you, as a consumer, have an unresolved dispute with a financial firm, you don't go to the FCA initially. You go to the FOS.
Right.
They're the independent dispute resolvers.
And what if a firm actually fails, despite the PRA's best efforts?
Then the safety net kicks in. That's the Financial Services Compensation Scheme, the FSCS. If an authorized firm goes bust and can't pay back customer money, the FSCS steps in and pays compensation up to certain limits for deposits, investments, insurance claims.
So multiple layers of protection.
Exactly. With the Bank of England itself overseeing the PRA and maintaining that overall financial stability, acting as the lender of last resort in a true crisis, it's a complex but deliberately layered system.
So wrapping this up then, the Twin Peaks model, with the FCA focused on conduct and the PRA on stability, isn't just some random bureaucratic structure. It's a direct, hard-won lesson from the crisis of 2008.
Absolutely.
Explicitly designed to tackle those twin challenges simultaneously.
Yeah.
Protecting you, the consumer, through fair treatment and competition, and protecting the entire system from collapse by ensuring the major players are robust.
Precisely. And for anyone working within the system, or even just relying on it, understanding that logic, that inherent tension in the different roles is really key. It's not just about memorizing rules from the FCA handbook or PRA rulebook. It's about understanding why they exist to build trust, ensure fairness, and maintain stability. Operating ethically and prudently within that framework is what gives the system credibility.
A really clear explanation. Before we go, any final thought for our listeners to chew on?
Well, here's something to consider. We've talked about how the success of this model rests on balancing the PRA's tough capital requirements with the FCA's continuous pressure for ethical behavior. Which of those two jobs do you think is fundamentally harder to supervise consistently? The numbers on a balance sheet or the nuances of ethical culture and fair treatment, especially when financial innovation keeps changing the landscape?
That's a great question. Balancing hard numbers versus soft culture.
Something to mull over. We'll leave you with that thought.